After reporting phenomenal gains in both stock prices and revenue over the last couple of years, Celsius Holdings is feeling some growing pains. The stock price is down over 25% in the last 3 months, and the stock price fell after the company reported disappointing third quarter 2024 financial results. So in this video, I'm going to review why the stock price is falling, what's causing the stock price to decrease, and answer if Celsius Holdings stock is a buy on this dip here, or if you should avoid this falling knife. I'll let you know all of that in this brief video, so let's get right into it.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right, so the primary reason why Celsius stock is down is because of a decline in overall revenue. You can see here in third quarter 2024, revenue declined by 31% to $266 million. That was a sharp reversal from a company that's growing revenue significantly, expanding into new markets and new categories, to experience a year-over-year decrease. Was an abrupt shift and shock to investors that were expecting growth to continue for this innovative beverage company. The company's CEO saying that Celsius continued to drive energy drink category growth at retail in the third quarter and outpaced the category in dollar and volume sales gains despite overall category softness. Pronounced supply chain optimization by our largest distributor, which is Pepsi, which we believe has largely stabilized, had an outsized and adverse impact on our operating results during an otherwise solid quarter. Now, the company's management, the CEO here, stated this in very rosy terms, but I think there is concern there. The reason Pepsi decreased their purchases of Celsius's energy drinks is because they noticed a lower demand in end markets. Consumers were consuming less of the company's beverages, and so PepsiCo wanted to optimize the inventory levels to better match the end market, to better match consumer demand at the end there. So, of course, the management team here is optimistic about this, but I'm not so sure just yet. Now, this is a newer company, so when you experience a decline like this with a newer company, you can't be so confident that there's going to be a rebound and growth will resume. So that's one of the risks there. Was this a temporary decrease in end market demand, and will Celsius continue growing? Or is this a permanent decrease in end market demand as consumers tried Celsius over the last few months and over the last few years, and now they're saying, you know what, we tried it, maybe we go back to Red Bull and Monster instead? I don't think that's the case. I do think it's more temporary. I do think that consumers have grown to liking Celsius's beverage, especially the more health-conscious consumers. Celsius is the better choice over Red Bull and Monster, and I do believe longer term, demand will continue growing for Celsius. But there is a risk that it won't, and investors need to acknowledge that risk here. The CFO chimes in and says that gross and operating profit margins in the third quarter fell short due to the significant reduce in orders because their largest distributor implemented a sizable, successful, and efficient supply chain optimization program in the quarter. Still, their strong balance sheet enabled them to acquire a long-time Celsius co-packer, Big Beverages, which we believe will unlock innovation and other supply chain efficiencies. This is interesting because Celsius had up until this point taken a asset-light business model approach, deciding not to own the supply, not to own the manufacturing, but rather outsource the manufacturing to partners like Big Beverage. And now with the purchase, they're now bringing in-house some of that manufacturing. It makes sense to some degree when you grow larger and more established as a business to try and bring some manufacturing in-house, because you can feel more confident about demand for your products, and so you can bring manufacturing in-house. and you don't have to fear the big risk there. And the big risk is when you have manufacturing in-house, you have to pay for that regardless of where sales go. So when sales increase, that's great news for Celsius because the manufacturing is in-house, and so they get to benefit from economies in scale. Their costs will not rise by as much as sales will rise, thereby creating a gap between sales and costs and delivering better bottom line profitability. But the opposite is also true. When your sales decline, your costs don't fall by as much as your sales fall, and so your profit gets shrunk in times of difficulty. So you're taking a risk there. There's bigger upside when you have manufacturing in-house, but there's also bigger downside when you have manufacturing in-house. So this signals a couple of things here from management. Number one, they feel confident that growth of their products are going to continue, that this was just a blip in decrease in sales, and they can be reasonably confident because they have a strong relationship with PepsiCo. And PepsiCo has undoubtedly communicated with Celsius and told them this decrease in orders is temporary. And that's why Celsius could feel confident that it's temporary, that it's going to decline, and that thereby making this purchase of the manufacturing make more sense. I mean, if you think about it, they paid roughly $75 million for this acquisition, and third quarter revenue was $266 million. So not that large of an acquisition when you compare to the company's overall revenue and when you compare to the company's overall profitability. It's not that large of an acquisition. It's not that large of an entry into manufacturing for Celsius. One of the things I wanted an update on from Celsius, and they told us that the international expansion is going well. Sales of Celsius in Canada and the UK and Ireland continues to exceed the company's initial expectations for the third quarter of 2024. That's great to hear. One of the benefits of Celsius and one of the growth drivers is going to be this international expansion. And the question mark remained, will international markets absorb Celsius's beverage as well as domestic markets have? And the early answer is yes. And that's great news for Celsius investors. Now, sales in Australia and New Zealand began in the third quarter of 2024 through major national retailers, and that's good to see. Now, in the next quarter, when they update, we want to hear more about Australia and New Zealand and get further updates about the Canada, UK, and Ireland, and also hear about any new markets the company might be entering. Now, with the acquisition and as they digest the manufacturing facility, that will give them more confidence in the international expansion, more confidence that they'll be able to supply these markets with the beverages. And remember, when you're going into international markets, sometimes you need to adjust and customize your product for the international market. And when you have manufacturing in-house, it allows you more customization capability if you need to customize and adjust your product offering in various different markets. So I mentioned that Celsius's stock price is down and it's been falling here in 2024. I rated Celsius stock a buy on August 12th. I did not have the stock rated as a buy until this point, and I rated it a buy on August 12th. However, since my recommendation, the stock price is still down. It's down over 25% in the last 3 months. My recommendation started on August 12th. The stock is now trading at a forward price to earnings of less than 30. And this is the cheapest you've been able to buy Celsius stock in the last year. Now, the question mark remains for investors. The big risk remains is, will PepsiCo increase orders, increase demand from Celsius as they see the demand from their end markets and the international markets, what you feel demand for Celsius will be. It's a high risk, high return potential investment. So to update my recommendation, do I still think Celsius stock is a buy following these recent developments? The answer is yes. I still think the stock is a buy. However, the risk has increased substantially, but the valuation has also decreased substantially to offset the higher risk you're now facing with Celsius stock. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.